Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today for a market briefing and to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. So happy Halloween to you, Tai.
Happy Halloween. It's also Diwali, so happy Diwali to our Hindu viewers, and welcome back from Las Vegas.
Yes, thank you. I am so glad to be back. When I landed last night, I thought there was a potential for the Yankees to win, but alas, not the case for the World Series. But as you mentioned, it is the Festival of Lights.
Yes,
today.
it is, and you're appropriately dressed for Halloween.
Thank you.
A great move, great move.
Thank you. So it is Halloween orange, and we are seeing some red in the markets today. But before we get to that, today is not only Halloween or the Festival of Lights.
It's John Keats' birthday, the great English poet, who, believe it or not, he died when he was only 25 years old. And like, what could he have produced had he lived longer? But one line I always remember from Keats is he wrote, "It is better to lose your ego to the one you love than to lose the one you love to your ego," which, when you think about it, is actually pretty wise. It's also Vanilla Ice's birthday, but I'm not going to torture anybody by singing anything. So, but as you said, a lot of red in the markets today.
Yeah, if we look at the major stock averages this morning, we're seeing the Dow off nearly 400 points. And we have to keep in mind that today is the final trading session for the month of October. And I know there are a few key levels you're watching in order for the major averages to close higher with gains for the market. So right now, we are seeing the Dow lower by about 400 points now, nearly down 1%. Also, the NASDAQ is in the red as well, down by 2.3%. The NASDAQ off by over 400 points this morning, and the S&P 500 down 1.5% or nearly 90 points as well. So I know that you're looking at the levels for the S&P 500. In order for us to close with gains for the month, what do we need to see?
I think we need to get back up to rally about a 0.6% back up above 57, 57. So plenty of time for that. But the S&P 500, I think it's been up monthly, at least 5 months in a row.
Yeah.
So we stay down here, we'll break that streak. And I think part of that certainly is tech, and we'll look at the earnings in just a second. But part of it also, I think, is there's a little bit of some jitters, I think, ahead of the election. We've had a great run in the S&P 500. Part of that is sort of a low regulation, friendly friendly to the market Trump trade, and people might just be also thinking, heading into the weekend, they may be trimming some bets.
And tomorrow is November 1st, Tai, so that means everything that we have been talking about the last several weeks, from the jobs report tomorrow morning, which you and I will be covering here at the New York Stock Exchange, followed by next week we have November 5th, we have Election Day, followed by the 6th and 7th, where the Federal Reserve will be meeting and announcing their rate decision for the month of November. But we did get PCE figures this morning.
We did, and PCE came out right on consensus. Year on year, it's 2.1%, which is great for the Fed. That's what the Fed is really looking for. I think core PCE was a little bit higher. Actually, I forget the exact number, but let me see if I have that right here.
So last month it rose 2.1%, and core PCE, it does look like, excluding food and energy, rose 2.7% last month.
So in a place where the Fed is sort of happy, they would like to see it lower. I did notice that month on month, it was up 0.3%. That's the overall PCE number, which is annualized over a year would be a problem. But right now, that was what the market was expecting. We know really what's going to happen next week. There was actually some other pieces of data out that are worth mentioning. Initial claims,
down.
Low again, very much lower than expected last week, and pretty low again, 216,000. So looks like that was literally like a 1-2 week problem of the hurricanes rolling through the Southwest. So that's pretty interesting. The other thing that I watch is personal income and spending. And personal spending is actually, so people look at retail sales and they look at it more, but 2/3 of what Americans spend is really on services, and that's not captured in retail sales, but it is captured in personal spending. And personal spending was up 0.5% versus an expectations of 0.4% last month. Just the American consumer spends $20 trillion a year. So 1/10 of 1% is $200 billion, and that's what is the engine that really drives our economy. And maybe that's something that China needs to work towards, but they're not quite accustomed to that yet, and they don't think about it that way, at least not yet. But that might be their easiest path forward. A little bit of a different topic, but that the personal spending is up suggests that heading into the holidays, people have a little more confidence. Consumer confidence was pretty strong the other day. And the other thing I also noticed, and I don't watch it too closely, but Challenger job cuts fell early this morning. But over the year, it's actually the highest job cuts, and what they do measure is the number of announced layoffs. So Boeing announcing that many layoffs will hit that number. Whether they do that in the end is unclear, but this is purely on announcements. And we have seen more job cuts this year since 2009, with the exception of 2020, which is an outlier. And most of that from tech.
And before we move on to tech and look at the latest earnings reports, I think it would be helpful for viewers, especially ahead of tomorrow's big jobs report, to talk about the differences between the Challenger job cut report and ADP, because that report earlier this week came in above expectations. So what are the differences there, and what does that tell you right now about the labor market in the U.S.?
So it's a good question. So Challenger job cuts is literally just announced layoffs. They tabulate the announced layoffs. It's not a huge figure. It's worth looking at it from time to time just to make sure that it's not doing something that beneath your notice. ADP, which came in twice as large as expected yesterday, which is pretty big, has historically been very volatile. The best thing about that number is literally the clients of ADP. I mean, I've gotten checks that are from companies who work through ADP. So those are real numbers. Those are real paychecks, right? But it may not be as representative a sample as the payrolls report, which is two: the household survey, which goes to about 60,000 households, and then the establishment survey, which I think is about 200,000 businesses. And it's why the establishment survey gives us payrolls and the household surveys gives us unemployment, which is why you need to look at both of them, because they're actually different surveys. So the market has always looked at the payroll report. That's a broad survey that's generally considered pretty good, though every year they excuse me, they have to make some adjustments. That's sort of the gold standard. But the ADP is also worth watching as well. And what seems to me the bump up in hiring suggests that even though we've seen some layoffs, some significant layoffs over the course of the year, a lot of companies haven't been hiring, and I think you may be getting to a point where some companies are saying, well, the economy isn't slowing down quite like we think it is, and we're seeing 2.8% growth in GDP. The report yesterday in the quarter, that's pretty good, right? That is solid. So they may be short of some people. So they may be, saying, you know what, we need to fill these spots, while we can. So that's the sense I'm getting from the market, that people are still cautious, but there are some firms that are hiring because they need to.
And Tai, you also mentioned the effects from the hurricanes earlier this month, Hurricane Milton, Hurricane Helene, and how it affected the southeast region. And ahead of tomorrow's non-farm payrolls report, unemployment rate coming out from the U.S., there is a lot of anticipation, and we've been hearing, different numbers, whisper numbers for what the unemployment rate, NFP, will be. But what are your expectations?
It's a tough one. I mean, those payrolls numbers can be quite volatile. Can be quite volatile, even under normal circumstances. And with the two hurricanes, I don't know. Let's take a quick look and see what the consensus is expecting tomorrow. We have payrolls. Consensus is 113,000, and that versus the previous 254,000. That's clearly, I think, Helene related. The unemployment rate is expected to stay at 4.1%. So I think the payrolls number, could be, honestly, I think it could be anywhere from 50 to 150. But I think the market will discount that just because of the things that we've just mentioned, and knowing that the Fed is going to cut in November, pretty much for sure. and very, very likely in December. And then I think they sit back. Then they'll have to see the new administration, how is everything going, particularly with Trump. That's going to be a change from the current administration. They may sit and wait and see what new fiscal policies come in, which may impact inflation and have to make them a little more cautious.
And another thing that we have been talking about all October is Boeing. So we're seeing shares of Boeing lower in today's session, but there have also been headlines leading up to this jobs report coming out tomorrow in the U.S. that the strike at Boeing might also affect the numbers as well.
Yeah, it should affect the numbers, but not the Boeing numbers themselves, but all the suppliers around them in states like Utah and Missouri and Montana, where the governors of those states all said, as a matter of fact, I think yesterday or the day before, we'd really like you to resolve this strike because it's downstream. It's hurting the suppliers because Boeing is hoarding cash. They're telling their suppliers, we're not buying because we have to hold on to cash. And they just raised $21 billion. So they were up yesterday, down a bit today. All things being equal, when you dilute your when you dilute your equity by $21 billion, if it's not a bad, actually not a terrible performance. So I think they're sort of Kelly Ortberg is battening down the hatches and waiting to fight this out.
Well, we'll keep you updated on any progress with that company. But of course, I do want to move on to earnings.
Yes.
So we have Apple and Amazon after the bell, but let's start by looking at the tech names, starting with Meta. So we are seeing Meta down this morning, down by about 2.5%. So tell us, it does appear we have the chart here, so it is extending losses and down about 3%. So what is going on here for Meta, the parent company of Facebook?
So it's hard to think of them as Meta. I'm thinking Facebook.
I know,
Facebook,
that's, yeah.
say Facebook. But, it's all the move into the metaverse, and that's still what the company is focusing on. They had a nice EPS beat, earnings per share, and a modest sales beat. But what the market is a little concerned about is the focus on metaverse. Zuckerberg saying this is the future. We've spent billions. We're going to continue to spend many billions on this, and that's got the market a little concerned. And plus, given where the stock is trading on on a relative basis, you could say that maybe valuations are a little bit stretched, and people are saying, well, it's had a good run, not so sure. Maybe book some profits. We are getting towards the end of the month and the end of the year. I think we're seeing that in sort of different names, but certainly Facebook is hurting some of the averages. Microsoft, they beat as well, but they're down. They fell in extended trade last night. I think they're down today, right?
Yes, over 5% in New York morning trade.
That's worse than when I looked at it last. Listen, it's had a great year, but they were a little concerned that capacity issues are constraining their cloud growth, where really they've been doing very, very well. And again, this is, I think, a little bit of similar to Facebook. The valuations are high, a little stretched, and the market's like, maybe let's take some money off the table. And sometimes the mood can cascade, as well as a lot of there's a lot of training with programs, and programs are trained to look at other stocks, similar stocks, so they may be adding to this sort of gloom, at least this morning. We've seen the S&P and stocks climb back over the course of September and October a lot, but over the past week, I think the S&P 500 has been sort of sideways and cautious and a little concerned. So I don't know if we're actually going to be able to make another monthly positive in the S&P today. It just that feeling, that trader's sort of gut feeling says, I don't know if we're going to fully recover today.
And speaking of other names that are seeing red this morning, eBay is off over 7% in New York morning trade as well. What is going on with eBay?
So eBay they narrowly beat on earnings, but they're projecting lower sales due in part to the hurricanes and the shorter shopping season because Thanksgiving is so late. And it's really remarkable that, I guess if it's early versus late, you can have almost a week's difference. And they're feeling that it's a little, it's going to hit them. And I think they're competing also with places like Temu, which are, really basic, cheap stuff, where eBay is sort of a little different market. So what the market is doing is, even if you beat, if your guidance is lower or they have concerns, they're punishing the stocks more. They really, the stocks are doing well, really either blew the socks off earnings or had really, really good projections. That's what the market really wants right now. And again, suggesting that with valuations this high, you really have to have a great story to get them even higher.
Yeah, you bring up an important point when it comes to the U.S. holiday shopping season. Thanksgiving falls later this year, end of November. Apparently, there are only 27 days between Thanksgiving and Christmas Eve, December 24th. And one thing I've been noticing, Tai, is I've started getting early Black Friday sale emails where a lot of these retailers are discounting already for an extended period of time. And I think it really speaks to this key season when it comes to a lot of the major retailers.
Well, we've already had an Amazon sort of, Black Friday deal already. I don't remember how well they did, but I just remember looking through it. And the bargains didn't seem to be sort of great. I mean, there were some things that I needed for the house, some things that the kids wanted, and I thought, all right, let's wait a few days and see if any of them come off. And they really, they didn't seem like the discounting, at least early for Amazon earlier this month, was that big. It may have to get bigger if people are reticent to spend, but that's why today's sort of 0.5% rise and higher than expected rise in personal spending may be encouraging for some retailers, many of whom see 50% of their sales and profits or their profits generated during the holiday season.
And speaking of looking ahead, we have Apple and Amazon, a name that we have both talked about. There's been a lot of anticipation about this, especially with the launch of Apple Intelligence for Apple. So we'll see what comes out of this. So tomorrow we'll be covering not only the jobs report from 8:30 a.m. in the morning to the results we get from Apple and Amazon after the closing bell.
So just some of the headlines I'm hearing about Apple, I'm seeing about Apple, it seems like they might surprise based on on uptake of their new equipment based on Apple Intelligence. Amazon's getting hit pretty hard today, but I think at the end of the day, it's their cloud services. It's going to determine the guidance on that. That's going to determine how the how the stock does after the earnings come out.
And despite this pullback we're seeing in some of the tech names post earnings, we have to keep in mind that in terms of valuation, they do remain high when we're looking at these names.
Yeah, absolutely. Something you can ask Dan about when he comes on for the
absolutely.
He's a better expert on that than me.
Well, before we wrap up, I do want to take a look at MicroStrategy. So,
MicroStrategy.
What is going on there?
So I love MicroStrategy. It's a software enterprise software company, and the chairman, Michael Saylor, decided that a while back that he said, you know what, I want to be a sort of a digital treasury company. I'm not sure if that's exact words he used, but basically he used all the money from the income from his enterprise software, and they only make $100 some odd million a quarter. So it's not a huge business. It's not tiny, but it's not a huge business. And they just plow that into Bitcoin. And for a while it looked great, for a while it looked terrible, and they've had a huge move this year. So let's look at graphic one. I was really this always I own this stock, and because before there were Bitcoin ETFs, it was actually expensive to buy Bitcoin because the spread was so wide. I should say expensive to trade it. So MicroStrategy has borrowed money to buy more Bitcoin. So they're basically a leveraged bet on Bitcoin. So if you look at the chart up here, the orange line is Bitcoin, and I use line charts because now I have to compare, and it's had a pretty good run this year. But look at MSTR, which is MicroStrategy, the leveraged bet on Bitcoin. And not only, so they missed earnings, but nobody really cared. They really cared because they're holding up 1% of all the Bitcoin, and Bitcoin's had an amazing run. Just missed all-time highs. We'll probably hit it. I think unless Trump loses. I think there's a big correction if Trump loses, but we'll probably hit it. So they want to borrow $42 billion in the next 3 years to buy more Bitcoin. Right now, they only have $3 billion in debt and hold $18 billion of Bitcoin, which is pretty awesome. But if you borrow more money so you can buy Bitcoin, leverage buy Bitcoin that much, if it turns south, that could be, that's not going to be a real pleasant chart. The other thing, the last thing on that chart, and we're not have to show it again, but it tells you sometimes this market is looking for things to sell. There are ETFs now that give you 2x of MicroStrategy. It was MSTU. And boy, I mean, now if you want to play with a live grenade, that's a live grenade, because, I mean, if MicroStrategy isn't volatile enough for you, you want 2x MicroStrategy. That's like going to Vegas, where you just were, and say, not only do I want to put it on red, I'm going to put it all on light red, right? Wow. I mean, you could do really well, but you could, those leveraged ETFs, and I think maybe one day we'll have a market insight on them, are very, very risky. And you could, they could go up, but it's not the total gain, it's the path that it follows. So if you love risk and you love putting stuff on red, a leverage ETF like that you might consider. But MicroStrategy is fun and sort of risky enough for me.
But not too much risk. So you mentioned Bitcoin, and year to date it is up by over 60%, especially given the recent move higher. It's still holding above 70, but it has yet to hit that record high that we saw earlier this year. And as you mentioned, we'll see in the coming days if we break those record highs. But just out of curiosity, for what you mentioned, the 2x MicroStrategy play there, how volatile are we talking when you say extremely volatile?
So if actually, can we bring up the graphic 1 back again? It's actually easier to see than for me to explain. So you see that white line, and that ETF just started a couple months ago. Look at how sharp and how steep it is, and how much it moves compared to the pink line, which is actually MicroStrategy. So that's the volatility you want to deal with. So, I like to I like to sleep at night, and that's a volatility on volatility. So listen, there are people who trade it, there are people who like it, and it gives you great leverage, but great leverage comes with a tremendous amount of risk. But just on Bitcoin, the other day when it went through 70,000, almost $1 billion that day went into the 12 Bitcoin ETFs, which in total now hold 23 billion. In the various ETFs. So it rallied on big volume. Not really quite sure what triggered that specifically that day, and we fell just short of all-time highs. We could consolidate around here, but now I think it's going to be sort of, now I think a lot of things will come down to the election. It's not usual that you'll see the markets turn on who gets elected, but I think we will definitely see this. See the moves. Expect some sharp moves, certainly in Bitcoin, because it'll be trading all night, the evening and the night of Tuesday, and then the Wednesday morning as the results start to come in.
And Tai, you bring up an important point, because I'm sure you and I on Tuesday evening will be watching very closely to see what happens. And we know that when it comes to the crypto community, they have been investing on both sides as well, and it has become a big campaign issue this year for the 2024 election. So we will take a closer look at that as we head into the coming sessions. But Tai, of course, tomorrow morning, 8:30 a.m. Eastern Time here in the U.S., we get that jobs report for the latest month, and expectations are pared back ahead of that, especially given the hurricane and the ongoing Boeing strike. But Tai and I will be bringing you the latest coverage tomorrow morning on the jobs report and earnings we get after the bell.
And also the end of the week update on the election. I actually put on a new the new Kalshi app, which allows Americans to trade on the election. just for fun. Yesterday it was 62-38 Trump over Kamala, and I put some money on Kamala Harris. Not because I think she's going to win. I think Trump still has the edge, a very, very narrow one. But buying at 38 with a chance to make 100, I just think that market is mispriced. So on predicted, it's a little bit closer. It's probably like 55-45. I didn't get a chance to look at Poly Market, but looking at Kalshi, that moves around a little bit. And whether or not that's a true predictor of the election, if enough people are watching it, I want to watch it as well. So we'll get an update of the election tomorrow. Looks like Harris has made up a little ground, might be leading in a couple of the swing states, but right now it's still leading leaning Trump, although we still have the weekend to get through.
Yep, hard to believe. We'll see what happens as we head into the weekend, and Tai and I will be bringing that to you tomorrow. So thank you so much, Tai, as always, for joining me.
Great to be here.
And coming up, I'll be joined by Dan Ha, partner at Karani Asset Management. We'll be right back. Don't go away. Welcome back to Global Money Talk live from the New York Stock Exchange. Earnings season continues in earnest as we head into month end. Alphabet Class A shares initially rose after strong results driven by its cloud division. And in New York morning trade, we're seeing shares nearly flat on the session. Meanwhile, Meta Platform shares declined while Microsoft stock increased after earnings reports, but is off about 5% in New York morning trade. Apple and Amazon will report earnings after the close. And this week, about a third of S&P 500 companies announcing results. Joining me this morning is Dan Ha, partner at Karani Asset Management. Dan, good morning, and thank you for joining me.
Good morning. Thank you for having me.
Well, let's start out with a look at Google Class A shares, Alphabet shares. So what did you make of the results from the company?
Sure. So I was on the show recently talking about Google and Alphabet. By the way, I'll be using them interchangeably a lot. Of having a attractive risk reward for an investor. My view still is the same. I think the perception that there is in the marketplace that that Alphabet is behind in AI, and how AI is going to be an existential threat to Google's search business. obviously, those are issues, those are risk factors, but I still think that the jury's still out, and that I think it's worth betting on that the fact that it's more likely than not, or my view is that it's more likely than not that they'll figure out AI over time. So, you know, I still think it's an attractive risk reward. If you look at literally the first paragraph of Google's earnings prepared remarks, the CEO of the company, the CEO of Alphabet, Sundar Pichai, basically highlighted three things as to why he thinks Google is going to, or Alphabet is going to be a winner in AI. First, they have the technical infrastructure. You know, that's basically the hardware necessary to support the AI efforts. Second, a world-class research team. You know, Google just had two of its researchers win a Nobel Prize in chemistry. Now, I realize that it's just two of very many that they have, but still, they still are doing a lot of the most sort of cutting-edge research in their areas. And third, the global reach that they have, the installed base, which I also talked about last time when I was on the show. You know, so those three components really, they have what it takes to be successful in AI. And what they will have to do is really execute. If you think about you know, they have 7 products that have over 2 billion monthly active users. Those products are all using Google's AI capabilities behind the scenes. Apparently more than a quarter of the new codes that they wrote was written by AI. Obviously, there was human involvement too, ultimately, but it was written by AI. So, you know, the AI tools are also making Google's cloud better. The AI capabilities are making YouTube better recommendation, better tools for content creators and management of that content. Their AI capabilities also making Waymo better. So, and also just in terms of search, which some people think Gen AI presents a existential threat to, Google thinks AI actually supercharges their search business. Now you might say, well, what else are they going to say? Sure, you know, they are talking their own book, if you will, but you know, the search results, the improving search results, and sort of the improving monetization of the search business through the use of AI behind the scenes is something that could definitely be a positive for the company. So there's obviously, you know, the perception, unfortunately, Google's, the rollout of the consumer-facing product. In the earlier days, there were obvious missteps that's kind of gave this perception that Google is behind in AI. But like I said, I think the jury's still out. There's a lot going on behind the scenes that I think are quite promising. And given the three components that I mentioned, or that the CEO of Google mentioned, that I agree with, I think the chances are pretty good, pretty high, that they figure it out, and it really, at this point, I think comes down to execution.
Yeah, so speaking of execution, Dan, so I think that was a good primer to what we're discussing, and perhaps when you look at an organization such as Alphabet or Google, you might just think of key products there, but they are leaders and very dominant in some of the categories that you mentioned. So can you walk us through how you expect the company to execute well?
Right. So my confidence, if you will, in Google's ability to execute, which by the way, as is the case with everything I say, just because I'm confident doesn't mean it's going to happen, right? But the confidence that I have really comes from the confidence in the quality of the organization and the culture of that organization. Now, culture can be a controversial topic for Google. There are a lot of people who will tell you it's not what it used to be. You know, Google has changed, the culture has changed, et cetera, et cetera. when I say that I have confidence in Google's culture, that they'll be able to execute, that they'll continue to innovate, and that they'll continue to be able to monetize their innovations, I'm not talking about the culture that took Google from 0 to 10 billion. I'm talking about the culture that that allowed Google to be successful from say 30 billion to 300 billion in revenues. So obviously there's been changes at the company. I mean, as companies grow, cultures change. But just because culture has changed, just because it's not what it used to be, doesn't mean that it's no longer effective. It can still be plenty effective. And I think that's the culture necessary to take Google to the next level. I mean, you read media stories about, how Google has changed, and, some of these more visible missteps that are very public, that indicate that something might be, broken at the company. Big part of our job as investors is to compare perception versus reality. And, there's obviously this perception, but also the reality is, for instance, Google has won something like 16 consecutive years as best place to work, or one of the best places to work by Glassdoor. It's something that its own employees vote to get you on that list. 16 years in a row, I don't think any other company actually has that record, or if they do, it's really very few. And just because it's a place where employees are happy to be, doesn't necessarily mean that it's innovative and strong in execution. It could very well mean that it's just a comfortable place for people to be. And trust me, we know several of those kinds of places too. But in the case of Google, people are still clearly satisfied, happy to be there. It's still attracting a lot of good people and capable people. And that is combined with, the innovation, the progress, and the results of the company. So, as I sit here, there is really no good reason, other than sort of a string of anecdotes, if you will, which, anecdotes, you do have to take it with a grain of salt. Other than a string of anecdotes, I see no good reason to conclude that something is, say, broken at Google. And our view is that, it's largely the same culture, like I said, the same culture that took the company from, say, 30 billion to 300 billion. Not the culture, the very early stage culture, but the more later stage culture that was still very effective and successful. We think that's largely intact, which is what we base our confidence on.
And with an organization such as Google, we think about the company when it first started decades ago, so it has been around for a while. And what takes an organization from startup to a mid-cap to a large-cap, mega-cap, there are so many different steps, layers, and especially when you go public on a major exchange, there are different obligations for a company, shareholder obligations. But you mentioned corporate culture, and we know with an organization like Google, there have been stories about the company, what it's like to work at Google. A lot of young students aspire to work at Google, and even within Silicon Valley, each company has its own culture. And I understand this is very important for you at Karani Asset Management to look at corporate culture. So can you walk us through the why and what you actually look at?
Sure. So if we take a step back and think about, in the public markets, what causes big price moves? Big price moves are usually the result of surprises. So we're in the heart of earnings season right now. Big moves in stock prices in the near term. When do we get them? When a company reports better than expected results, price goes up. Sometimes it goes up a lot. When a company delivers worse than expected results, i.e. negative surprise, the price goes down a lot. That's in the short term. It also applies in the long term. a company that ends up over the next 5-10 years much better results than what the market had anticipated will end up delivering positive alpha, strong positive outperformance. When a company delivers results, a company that was expected to be, continue to do well and have a strong position in the market ends up disappointing on that, again, negative surprise, that's when you will have negative alpha. So in the public markets, big moves or alpha is usually the result of surprises. So at some point we sort of thought to ourselves, what if there's a way for us to sort of systematically capture these positive surprises and also systematically avoid negative surprises? And in thinking about that, we ultimately came to culture. We have a saying at our firm, at a company with a good corporate culture, what the world does not yet know is probably something good. At a company with a bad culture, what the world does not yet know is probably something bad. We as public market investors, we only find out about things that are happening at the company like after the fact, right? There are always things brewing at any given company. Sometimes it's a good surprise, sometimes it's a bad surprise. So by focusing on culture, we could actually construct a portfolio that is over-indexed to positive surprises, and therefore, by definition, less exposed to negative surprises. And we're in our business, we're all trying to predict the future, which is very difficult to do. People use different methods to try to predict the future. At our firm, what we're doing is, culture actually is, in our view, among the most durable aspects of a company. Product cycles change, or products change, people change, market environment changes, the economy changes, competitive landscape changes. Culture is among the most durable parts or aspect of a company. It usually doesn't change very quickly. It is possible for it to change quickly. There are examples of that. And sometimes culture can deteriorate really quickly. But unless management is really trying to destroy it, usually it moves pretty slowly. What that means is if you focus on culture, you could increase your chance of being right about predicting how a company will behave in the future and over the long term. So by focusing on that's why we focus on the culture. And another a great thing about the beauty of focusing on culture is something that we can study now. We're basically trying to understand the culture of the company, what the culture is today, and because it's slow to change, we can rely on what it is today, continuing to be true for over the long term. Again, no process that involves that's trying to predict the future is perfect. Every process will yield some false positives. I kind of compare picking methods to trying to predict the future to picking poison. So it is picking poison, but in our experience, in our view, focusing on the culture is among the best of the options available.
And when we have a discussion about corporate culture here in the U.S., it might be considered somewhat of a debate or a controversial topic because there are so many elements that go into corporate culture. And when we step back and look at some of the outcomes of the pandemic, we heard of new terms such as quiet quitting or quiet hiring, what was going on within organizations. Would these companies allow for remote work versus having to go in on a regular basis? And these are all the elements that go into making a corporate culture. And of course, in a country like the US, leadership and management make a big difference in direction for a company. So
Absolutely.
my question is, how do you actually measure corporate culture? How do you qualify or quantify an organization's corporate culture?
Sure. We get that question all the time. So first of all, culture isn't just one thing. You know, we say that culture is the way things are done at a place, at a company. And it's not just at companies. You know, if you think about our homes, there's a certain expectation of how things are done at your household, at my household. You know, we don't, for instance, my kids know that we don't do certain things a certain way at the Hof, you know, at the Haas.
Yeah.
You know, we all have that, and it's not written down anywhere, but they just know it because that's just how things are done. You could even look at it at a country level. I mean, you know, we often say things like, you know, that is not American. Like, that's just not what we do. Like, what does that mean? It's not necessarily written down somewhere. I mean, some of it is, you know, in the Constitution and whatnots, but not everything is written down, but we all know what that means because that's just how things are done in this country. That's the standard, that's the expectation. At a company, again, it's not necessarily, these things aren't necessarily written down. But for instance, at my company, we all know how we're supposed to treat our clients. We all know how we're supposed to treat one another. We all know what kind of behavior will get one fired and what kind of behavior will get one promoted. And those sorts of things are true anywhere you go. So culture, you know, ironically, it's very, in some sense, it's very clear, but it's also, because it's not just one thing, it's very difficult to quantify and measure. Having said that, the components that make up the culture, or the aspects of a company that tell you about the culture of that company, many of those are trackable, observable, and measurable. So, you know, for example, in a manufacturing company, safety records is something that gets disclosed. And you can compare safety records to, you know, to the industry, sort of to the industry averages. A company that has terrible safety record and consistently bad safety record, you know, you could assume that employees at that company probably aren't very engaged, because it's hard to have really engaged, happy, you know, workforce at a company that doesn't care about employee safety. And the opposite is true. A company that really has strong and consistent safety history, you know, you could assume that employees at that company know that management and the organization cares about employee safety. I'll give you some more examples. Atlas Copco is a company that my partner Richard mentioned recently when he was on the show. This company really values decentralization. They talk about how, you know, consultants will tell them that, or sometimes investors will tell them, hey, if you were more centralized, your operations would be a lot more efficient. You know, you could get rid of redundant costs. It'll be much more efficiently run. But the company proudly talks about how their decentralization, even though it may cause the company to be less efficient, what they gain in return is speed and better information on the ground, and being able to act on that information with speed, which they are convinced and have demonstrated over a long period of time is actually a good trade-off. For a company like that, if we start to see that behavior change, for example, that'll be something that we would watch closely and would potentially be a red flag, because we know that the success of the company, a key factor in the long-run success of the company was that structure. So when that changes, say new CEO comes in and the first thing he or she does is well, we're going to become more centralized. Like that'll be a red flag, and that's something that we could observe. Hermes, company that I talked about at some point, it's a very conservatively run company throughout generations. The company has a corporate structure called partnership limited by shares in English. What that means is that it's kind of like America's limited partnership structure, where the limited partners have limited liability, but the general partner has unlimited liability. Partnership limited by shares is a structure where, for the management of those that run the business, the liabilities of the business can have personal liability for the liabilities of the business. You could bet that when you run a business with that kind of structure, that you'll be very conservative in the way you run the business and the liabilities that the business takes on. If that structure changes and we start seeing the company be run more aggressively in terms of balance sheet and risk, that'll be something that'll be obvious that would be a red flag. Just a couple of more examples. Costco, I talked about at some point, right? Costco has a very clear limit on how much markup they put on top of their cost. For Costco, that is a brand promise, and that brand promise is very important. If we start seeing changes in that behavior, start seeing them have a lot more gross profit, which the market may welcome in the near term, but to us that would be a red flag, because that signals a change in behavior, a change in culture. And lastly, there's a company called NVR in the home building space. Been a very successful business and a stock for multiple decades. After going through a near-death experience, taking on balance sheet risk, because most home builders take on balance sheet risk by buying land. This company said, you know what, never again. A lot of companies will tell you never again, but you do have to watch them over time if they actually really stick with that. This company has demonstrated over multiple cycles that we're not taking on balance sheet risk. We're going to manage the business conservatively, and if something changes, shareholding or senior management, and if we start seeing them take on balance sheet risk, that'll be a red flag. So those things, the aspects of the business or of the company that tell you about the culture, and that they've demonstrated over a long period of time, those are things that we can continue to monitor, measure, and track to make sure that the culture remains intact. And just the last thing I'll just say about that is, often when we think about culture, people sometimes assume that maybe we favor sort of smaller companies, because usually good corporate culture is associated with family-like environment and sort of that small company vibes. But actually, we usually prefer companies that have been around for a long time, and usually companies that have been around for a long time successfully tend to be larger. They usually don't remain small if they've been successful, and that's because we want to see, like I said, we want to see companies that have demonstrated these cultural traits over a long period of time, so that we can be sure, so that we can know where in the company's history that what the sources of the company's success has been over time. So that's why culture is really important to us. But obviously, we don't just look at culture. The obvious other aspect to consider is the strength of the business, which I'd be happy to talk more about.
Yes, I do want to ask you about that, Dan, but very quickly before we get to that, you said that corporate culture, especially for large, successful companies that have been around and has been time-tested, that the culture is usually very slow to change if it is going in a negative direction. How much does succession affect that?
Yes, so succession, part of the looking at culture, and we try to be data-driven, as data-driven as possible, because you could easily, fall for charming stories and, kind of sort of the more sort of qualitative aspects of a company's culture. And it could be a trap. So we're very focused on looking for evidence, quantifiable, trackable evidence when we evaluate culture. But that doesn't mean that our approach is just purely quantitative. There's science part. The measurement is science, but the application, applying that is an art. And the art part of what we do is there because you can't apply these things universally. So succession. In some companies, senior management change, or the founder retiring and sort of handing management off to professional management. For some companies, that could be a bad thing. For some companies, that could be a good thing. So you do have to know the context to know how you apply these different attributes or aspects of the corporate culture of the company. So there's not one way to answer how is succession important or not. It really depends, and I'm not avoiding the question because, like I said, in some cases, new management is a good thing. In some cases, it's a big challenge. But one thing I will say is we like seeing companies that are actually been around for a long period of time, that are actually on their third or fourth or fifth CEO, and that the company's culture remains intact, because that to us indicates that the culture at that point is really in the water of that company, if you will. It's really in the DNA. It's not being driven by just one person or just one generation of management. It's really part of the company at that point. And in that case, we could have more confidence, and succession is less of a risk in that context.
And finally, before we wrap it up, Dan, I do want to go into what else besides culture you look at when you're picking stocks.
Right. So like I said, the business obviously matters. When we say we're culture first, that's the most important thing. That's the first thing we look at. But obviously, you can't invest only based on culture. And like I said earlier, sometimes people assume that, oh, you must like smaller companies, because of this association of good corporate culture with sort of small company vibes and friendly culture and things like that. Actually, as an investment proposition, culture, we think, is more important for larger, more established companies than smaller companies. What we mean is, you could have the best group of people in the world come together and start a company, but if the product doesn't work, if the product fails, then the company fails. The company's over. Whereas at a large company, your product is definitely way beyond the proof of concept stage, and in fact, it's more likely than not you're in a pretty solid position as a business. You're already pretty well established. At that point, what matters more often than not, is execution. It's making sure that you don't fall behind. It's not being complacent. It's staying on top of your game. It's continuously innovating. It's pressing on your advantages to continue to win. And that is cultural. So, culture matters, again, as an investment proposition, we think even more at larger, more established companies. So we look to those types of businesses or businesses in that area, and we care a lot about the strength of the business, therefore. Companies that are in a position where they don't have to take on a whole lot of business development risk, that they're not really trying to bring a brand new product to the market, but are already in a solid position and are in a position or in a phase of their cycle where they have to where they're really pressing on their advantages to continue to win. So, companies that have, high switching costs, companies that are selling essentials, companies that are conservatively managed, those are good places to be in. And when you combine that with a strong, winning, effective corporate culture, we think that's a good combination.
Well, Dan, we are out of time for today, but thank you so much for such a thorough discussion on the various moving parts when it comes to corporate culture.
Thank you.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here tomorrow morning. Have a great day.